Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. Nation tech stocks just had their worst week since April, tumbling 3% with some AI stock favorites already down into bear market territory. But as some investors worry that this is the start of a stock market crash, I'm going to show you proof of why the sell-off is just a typical 5 to 10% correction we see each year that becomes a buying opportunity and the 7 stocks I'm loading up on. Stick around and I'll also update you on shares of Super Microcomputer, ticker SMCI, CoreWeave, CRWV, and how this new Supreme Court decision on tariffs changes our stock market outlook. First to that main topic though, and the last minute bounce on Friday couldn't save the NASDAQ Tech Index from its worst week since April, and while the market is only down 4% from its high, AI investors are totally freaking out with some of their favorites down much harder. Shares of Super Microcomputer crashed 23% on its earnings report, and AI data center company CoreWeave plunged 22% in the madness. I'm going to detail what started the sell-off, where we go from here, and why it is not the start of a stock crash before highlighting the stocks I'm buying on this dip. First, while stocks have been choppy around earnings, pain in AI started Wednesday when OpenAI CFO Sarah Friar used the words backstop and guarantee when talking about an ecosystem of funding for AI that included the federal government. Her comments were misconstrued to imply that OpenAI was looking for a government bailout, and that started the bears mauling on fears of that AI spending spree is over. Even a quick response from OpenAI CEO Sam Altman that the company was not looking for a bailout, and comments from the government didn't fully calm investors. Then the bigger news was a report by staffing company Challenger reporting October job cuts of 153,000, almost 3 times the cuts in the prior month, and the highest in 22 years. With no official jobs data on Friday because of the government shutdown, the market sold off on the fear that the economy is much weaker than we may know. Both of these combined with the fact that investor expectations have just gotten so high that very few companies have been able to satisfy the market. For example, SMCI had already warned the week before that a delay in orders would limit first quarter revenue to $5 billion. But investors have gotten used to companies beating any expectations. Even the company raising its full-year forecast to $36 billion in sales, that is growth of 65% from last year, just could not save the stock here. Even AMD, Advanced Micro Devices, reported a blowout profit of $1.96 billion, 30% higher from over the last year, and upped its current quarter outlook to $9.6 billion in sales. Now, shares were initially up on that news, then investors just gave up and sent it down 8% on the week. And while this is all a sign that the market has just run too far and too fast and needs that dip to cool off, there is still reason to believe it is not the start of a stock crash. First off, earnings reported overall have been very good, with companies in the S&P 500 index reporting profits up 13% from last year. That is way above expectations, and profitability is holding up. That's important because if that AI spending bubble were in trouble, you would expect to see that profitability fall as companies report less earnings on those strong sales, and we are just not seeing any of that yet. Now, another worry for investors, especially after that Challenger jobs report, is that the crashing jobs market is going to hit consumer spending just as we enter that important holiday season. While there are signs that the lower income group of consumers are stretched to the max, overall debt to disposable income is near its lowest on record. The amount of debt that average household owes versus its disposable income is well under where we have seen it become a problem in the past, and households are sitting on record levels of cash, $4.7 trillion in money market funds, and $3.4 trillion in CDs, all of that available to support their spending. Even against that weakness in jobs and lower income consumer spending, the Fed has a lot of room to cut interest rates and then boost the economy. The central bank is expected to cut one more time this year and twice next year, but could speed that up with even more cuts and deeper cuts if the economy weakens, lowering the cost of business and consumer loans. Nation, yes, stocks are expensive. The price-to-earnings ratio of the stocks in the S&P 500 index, the price investors are paying for every dollar in profits, that core measure of expensiveness, is at 29 times. That is 28%. That is 28% more expensive than the average PE ratio over the last 10 years. But stocks don't crash just because they get expensive. And we do see corrections, those small sell-offs of 5 to 10% nearly every year when the investors just get skittish and look to take profits. We've had a correction of less than 10% in 26 of the last 45 years, each of them avoiding a bigger drop and seeing stocks rally after that. So these corrections, they happen all the time. But for stocks to crash, to really fall to 20 and 30% from their peaks, there needs to be a catalyst. And we just aren't seeing anything like that would stop this bull market. That means this dip could quickly become a buying opportunity, and I'm watching 7 stocks to buy. First up there, I'm still up $73,000 on shares of Supermicrocomputer, that SMCI, and it remains my top pick in that AI theme. The earnings reaction last week in the shares was crazy. The company had already said that revenue would be $5 billion, but analysts were still expecting $5.4 billion. In the report, management said missed revenue last quarter would come in the next report and even raised its full-year sales target. Now, to the bear's point, yes, competition is hitting profitability here, but this company is still the leader in AI-enabled servers and a pure play on the theme. That means if you believe the AI bubble isn't done inflating, then this is the best deal in the space. This stock is now trading for a price of just 0.65 times its sales and growing those sales by 65% a year. That's a market cap of $23 billion as of Friday's close, divided by the $36 billion in expected revenue for this year. A price-to-sales ratio of 0.65 when the company has traded at twice that and as high as 4 times it in the past year. Outside the AI theme, I'm also buying the dip on shares of the Trade Desk, TTD, which reported 18% revenue growth last quarter and increased its current quarter target. All signs in that report are that the feared competition from Amazon isn't hitting the company's sales or profits yet, and the stock was initially up more than 2% after that earnings, but then plunged 7% on the day. What we have here, I think, is just hedge funds and other big money players maybe selling out, booking those losses after the stock has fallen 63% this year, using that against capital gains taxes, before maybe buying back in on that 30-day window for a 2026 rebound. Shares of UiPath, ticker PATH, are down 23% from its recent high after blowing the doors off its earnings report in September. The AI automation company increased its full-year forecast to $1.6 billion, swung to a profit on its earnings. Now, I don't have a big position here, but I'm still up 15% even after that dip, and an opportunity to buy more. And here, SoundHound AI, ticker SOUN, also got crushed, down 19% on the week and down 35% from its recent high last month. This has been one of my favorite next-level AI stocks, but was getting just too expensive for my taste. I'm still up 70% on my cost basis, and it's my 7th largest position, and now using the dip to buy more for a long-term holding. Cryptocurrencies rallied Friday, but Ethereum is still down 25% over the last month. Between the iShares Ethereum Trust, ticker ETHA, and the Grayscale Mini Trust, ETH, I have more than $675,000 in Ethereum and am buying more on this. That's because, Nation, we are seeing a new era in digital payments, with stablecoin payments surging after passage of the Genius Act. Payments of $10.2 billion went through stablecoins in August, a 126% increase from the last year, and Ethereum is a backbone of that infrastructure, with more than half the volume. On this sell-off, I'd also be buying the dip in shares of Arista Networks, ticker ANET, and Astera Labs, ALAB. Both networking hardware leaders sold off double digits last week, but are growing sales by more than 27% a year. More than buying the dip on these stocks, though, this is the perfect time for using an option strategy. Those big price swings mean that volatility is sky high, and that means the money you collect on options is going to be even higher. You're going to get more cash and more protection using strategies like the covered call or secured puts. For example, I collected over $146,000 in call option premiums on my position in the ETH and ETHA Ethereum Trust, money that lowers my cost in the shares and my risk, while still leaving upside of 50 to 60% on the price. But I know options investing can be confusing, so to help you get started, I'm relaunching our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through 29 option strategies, when to use each, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly what to expect. Right now, I'm relaunching the course at a 38% discount. Save $150 off, but only for the next 3 days. You're going to get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much money you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. Now, that $150 launch discount is only available with the coupon code in the link I'll leave in the description below, so look for that link or just scan the QR code here. On to the stocks I'm watching this week, and Circle Internet Group, ticker CRCL, reports earnings Wednesday and is finally at a point where I can start recommending this stock. The shares are down 50% just since its prior report in August, despite a very strong trend in stablecoin payments, reaching $10.2 billion, or a 126% increase over the last year. As for Circle, there was $61 billion worth of the company's USDC stablecoin in circulation as of June, an increase of 90% from the year before, and at about a quarter of the stablecoin market. I think that market share may have increased, with now the company reporting $75 billion in USDC in circulation, an increase of 23% just over the last 3 months. I still prefer investing in those Ethereum ETFs for that stablecoin growth theme, but we are getting to a point where shares of Circle are in value territory. At a market cap of $25.8 billion, the stock now trades for just 9.7 times on that price to this year's sales basis, which is about half as expensive as when I recommended against the stock when it was trading above $200 a share. Now, profitability is still limited by the fact that this is basically a bank making its money off that interest it collects on those treasuries, but the company could surprise higher when it reports that growth this Wednesday. CoreWeave Inc., ticker CRWV, reports earnings after the bell on Monday, and this is one all AI stock investors need to be following, even if you don't own the shares. That's because what CoreWeave does and the clue it might give you to that real popping of the AI bubble. The company builds and leases data centers, with 33 already up and many more planned. It is a hot market because this is where that artificial intelligence happens. There just aren't enough data centers, and it can take years to get one up and running. That means hyperscaler users like Amazon, Alphabet, and Meta that usually run their cloud and AI needs through their own data centers. They're paying CoreWeave tens of billions of dollars to build more and help with that demand. We've seen that in the company's revenue backlog, so the deals it has contracted to build out those data centers, growing its backlog 86% over the year to $30 billion, and I guarantee you that that has grown since the last quarter. But what I'm getting at here, and why you need to be watching this company's financials each quarter, is because this is where you're going to see those first clues that AI spending boom is slowing down. When the company's backlog growth starts to slow and as profitability starts to slip, that's going to be a sign that new data center demand and that AI spending is going to be slowing down. The hyperscalers will have built all the capacity they need with their own data centers, and they're going to stop announcing those multi-billion-dollar deals with CoreWeave, or that the company is just going to have to lower its price to entice those new contracts, a hit to profitability that's going to show us that slowdown. And that said, I don't think this is likely to happen in this quarter or even the next few, but it will happen, and that's going to be your clue that this market sell-offs in AI stocks aren't just the typical correction we're seeing right now, but a sign of a bigger crash coming. Showing you that bigger picture here with the Sector Spiders Sector Tracker, 7 of the 11 stock sectors managed to close higher last week, proving that winners can be found even in a sell-off. Even with the 4% crush in tech stocks for the week, the sector is still up 24% over the year and may have further to fall as that correction unfolds. But don't wait for too long to buy into this dip. Within those sectors up last week, energy and real estate are becoming safety sectors, with stocks in both groups already in value territory, so not getting hit when the rest of the market drops. Both are still in the red over the last year, along with materials, healthcare, and consumer staple stocks. There is still a lot of value to be unlocked in these two, and both should do well to protect, if not grow, your portfolio. Updating our stock market outlook, investors aren't going to get much planned news this week to help lift sentiment out of this correction. The government shutdown means we're going to get no economic data, including the month's inflation numbers. There will be lots of Fed speakers, but they're all likely to say the same thing, that the shutdown could start to hit the economy, but there's really no way of knowing it yet. The market is still pricing in 66% odds of a rate cut when the Fed meets in December, and recent weakness in that consumer confidence and private jobs data should move those odds even higher. As for third quarter profits, earnings season is mostly over, with 91% of the companies in the S&P 500 index having reported, though we are going to see some important reports from retailers over the next few weeks. It's going to be an important read on the health of the consumer, but overall, earnings have been very good, up 13% from last year and much better than expected, which is supportive of stocks. Looking at a bigger picture here, though, the Supreme Court heard arguments in the case against President Trump's reciprocal tariffs last Wednesday, and it did not go well, with prediction markets now forecasting a 75% chance that the tariffs are declared unconstitutional. Now, at issue here was Trump's use of emergency powers to take control of those tariffs, which are usually a power of Congress. The three liberal justices are sure to rule against the tariffs, and at least three of the conservative justices also questioned the government's lawyers skeptically about the president's justification in need for those emergency powers. That would be a 6-3 vote, striking down the tariffs. Now, of course, this wouldn't strike down all the tariffs, and Trump would likely just try to justify them under other laws, but it could mean the government has to refund tens of billions of dollars to the companies, the US companies that have already paid these fees since April. The court heard arguments on the 5th of November and technically has until the end of the term in June to rule on this case, but it's likely to speed this one along because of that importance of it. Still, we probably won't get a ruling before February at the earliest, and more likely into April. It might not change that near-term outlook on stocks, but mark your calendars, folks, because some of those retailers like Lululemon and Nike could explode higher when that ruling comes. Get your $150 discount and get started options investing to boost returns, lower risk, and create income with our Ultimate Options course linked in the description. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.